studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
When people are new to corporate taxation, they often assume that federal corporate tax is calculated by simply applying a tax rate to the accounting profit shown in the financial statements. In reality, the process is much more structured. Everything begins with the corporation's accounting net income. This is the profit reported in the financial statements after applying accounting standards. However, accounting rules and tax rules are not always the same, so this amount cannot be used directly to calculate corporate tax. The next step is to make tax adjustments. Certain expenses that are acceptable for accounting purposes may not be fully deductible for tax purposes, while some deductions permitted under tax legislation may not appear in the accounting records. These adjustments increase or decrease accounting income to arrive at the amount recognized under the Income Tax Act. After all required adjustments have been made, the result is the corporation's taxable income. This is the amount on which federal corporate income tax is calculated. In other words, taxable income, not accounting profit, is the basis for determining the corporation's federal tax liability. Once the taxable income has been determined, the federal corporate tax rules are applied to calculate the corporation's federal tax. This calculation follows the provisions of the Income Tax Act and considers the applicable tax rates and deductions available to the corporation. The final result is the corporation's federal tax payable, which represents the amount of federal income tax owed before considering any payments already made or any remaining balances. The key idea to remember is that accounting profit is only the starting point. Corporate tax is calculated through a logical sequence of tax adjustments that transforms accounting income into taxable income, and only then is the federal corporate tax calculated. Understanding this methodology makes the entire corporate tax calculation process much easier to follow. Accounting profit is only the starting point of the corporate tax calculation process. To determine how much federal corporate tax a corporation actually owes, the Income Tax Act requires a series of adjustments that transform accounting income into taxable income. The first step is accounting income. This is the net income reported in the corporation's financial statements after applying accounting standards. It reflects the company's financial performance, but it is not necessarily the amount on which tax will be calculated. The second step is making tax adjustments. Accounting rules are designed to present a fair picture of a company's financial position, while tax rules are designed to determine taxable income under the Income Tax Act. Because these objectives are different, adjustments are often required. Certain expenses may not be fully deductible for tax purposes. Some deductions are allowed only under tax legislation, and items such as capital cost allowance replace accounting depreciation. Other adjustments may include charitable donations, fines and penalties, meals and entertainment limitations, and various tax-specific provisions. Once all of these adjustments have been made, the result is the corporation's taxable income. This is one of the most important concepts in corporate taxation because taxable income, not accounting income, is the amount used to calculate federal corporate income tax. The final step is calculating the federal corporate tax. After determining taxable income, the applicable federal tax rules are applied to compute the corporation's tax liability. This calculation forms the basis for determining the federal tax payable before considering available tax credits and installment payments. Remember this key principle: financial statement profit and taxable income are not the same thing. Accounting income measures business performance, while taxable income measures the amount that is subject to tax under Canadian tax law. Understanding this distinction is fundamental to understanding how corporate taxes are calculated. To understand the complete federal corporate tax calculation process, it's helpful to look at the entire journey from beginning to end. Although the final objective is to determine the corporation's federal tax payable, that amount is reached through a series of logical calculation steps. Everything begins with the corporation's financial statements. These statements, including the income statement and balance sheet, are prepared using accounting standards and provide the starting point for the tax calculation process. From the financial statements, we determine the accounting net income. This represents the corporation's profit according to accounting principles. However, accounting profit is designed to measure business performance. It is not automatically the amount that will be taxed. The next stage involves tax adjustments. This is where accounting income is modified to comply with the Income Tax Act. Certain expenses that are not deductible for tax purposes are added back, while specific deductions allowed under tax legislation are applied. Other adjustments, such as replacing accounting depreciation with capital cost allowance and accounting for reserves or other tax-specific items, are also made during this stage. After all of these adjustments have been completed, we arrive at taxable income. This is one of the most important figures in the entire corporate tax return because it is the amount used to calculate the corporation's federal income tax. Federal tax is then calculated by applying the applicable corporate tax rules to the taxable income. After the initial tax has been determined, any available federal tax credits are applied. These credits reduce the corporation's final federal tax payable, allowing eligible corporations to benefit from various incentives provided under the Income Tax Act. A common misconception is that corporate tax is calculated simply by applying a tax rate to accounting profit. While that may seem straightforward, it ignores the many adjustments and deductions required by tax legislation. The correct approach is to begin with accounting profit, make all necessary tax adjustments, calculate taxable income, determine the federal tax, apply available tax credits, and finally arrive at the corporation's federal tax payable. The key takeaway is that corporate tax calculation is a structured, step-by-step methodology. Accounting profit is only the starting point, while the final federal tax payable is determined only after all required tax adjustments, deductions, and credits have been properly applied.